to this week's MFB news. I hope you're keeping really, really well. All fine here. I'm wearing headphones. It's very, very early in the morning. I'm trying desperately not to wake up the whole house. Obviously with the kids with school days ahead of them, they really don't want me making them up at this time of the morning. So look, it has been a bumper week in terms of lenders making rate reductions. Indeed, I was totting up and 12 different lenders have made amendments to their pricing, downward amendments I should add here. So a really, really busy week in terms of changes. I was actually reading a report in last week from Moneyfacts who are saying that in the last month the average 2-year fixed rate has fallen by 0.14%. The average 5-year fixed rate has now fallen by 0.12%, which is the largest reduction on pricing since May 2020. So lots of activity in the market. Obviously with rates coming down, this can only be a good thing for you guys as borrowers. So we'll go into that. We're also just going to touch on some data which has been released in relation to rental yields across the country. Obviously as landlords, yields are very important to us. If you're thinking about investing, this may help you drive the decisions that you make in terms of where you invest. We're going to go into that as well. So lots of good stuff to cover off with you this week. First up this week, it is Paragon, who have released a couple of limited edition products, which I have to say I think are fantastic. So these products are available to 75% loan to value, 2-year fixed rates now starting from 2.65%, 5-year fixed rates now starting from 2.99%. Now, if we look at the Paragon offering, you'll understand why I believe these products to be so very good. So first of all, they can lend to individuals, but also limited companies. Not just limited companies, we can also lend to layered companies as well. The key is that they have to be special purpose vehicles. So SIC code 68100 or 68209, please. No maximum number of properties in the background. They do need you to earn £25,000 a year. This can be made up of rental profit. There can be up to 4 applicants on an application. When they're looking at limited companies, they are going to be underwriting, lending to, taking personal guarantees from directors and shareholders. They can ignore anyone with a shareholding of less than 20% though. So for those people with limited companies with, for example, a child on the title or on the application, they may be able to ignore those. Now, in terms of the kinds of properties they would accept, so one of the things that makes these rates so very, very good is they are available on HMOs and multi-units as well as standard properties. So if you take into consideration that Paragon are able to lend on HMOs of up to 20 rooms, multi-units of up to 20 self-contained units, and then you throw into the mix that you can get a 75% loan to value, a 5-year fixed rate starting from 2.99%, you'll understand why I think these rates are so incredibly good. They're very good at sort of slightly quirky tenant types. They're fine with DSS tenants. They're fine if you let the properties to housing associations. And they're also really, really good at corporate lets as well. So you let your property to a company rather than to an individual. And lastly, they are able to accept day one remortgages. So remortgaging a property that you've owned for less than 6 months. They're able to lend against open market value as long as you can really demonstrate an uplift in value while you've been able to achieve that. So for example, I bought the property and did some work to it. So a really, really solid offering from Paragon here. The rates are very, very good. Foundation are another lender to have made reductions to both their rates and also their arrangement fees. They've now reduced their product fees to 1% on all of their 2-year fixed rates and reduced their product fee or arrangement fee to 1.5% on all of their 5-year fixed rates. They've also made rate reductions of up to 25 basis points across the pricing on all of their buy-to-let products. So what does this look like? So they've got now pricing starting from 2.89% at 65% loan to value and 2.94% from 75% loan to value. Now they've also made some changes to their short-term let products and also reduced the rates down here and also improved pricing on those short-term let products which have flat arrangement fees. So on their short-term let offering, which is essentially holiday let offering, they are able to offer pricing from 3.59% at 65% and 3.74% at 75% loan to value, which is not bad at all. So in terms of the Foundation Home Loans broader offering and the kinds of people they're looking to lend to, they're able to lend to individuals and limited companies. On the limited company side, they're actually quite strong in terms of what they do and don't accept. So they're only going to lend to SPVs, but they can lend to layered companies. One of their real USPs is that they will only take personal guarantees from the directors. They're not looking to underwrite the shareholders. They may need to do some due diligence in terms of money laundering, so verifying proof of ID and address, but they're not actually going to base their underwriting on the shareholders, which can really help with those people who have sort of the more unique shareholding arrangements in place. No maximum number of properties in the background, no minimum income requirement. They're able to lend to older applicants. They can do day one remortgages as well. So really, really solid offering. Also within their product set, so like I said, they have short-term letting. For these guys, essentially what they're saying is on their short-term let products, they understand that you're not going to be letting the property on 6-month or 1 yearly ASTs. Beyond that, they don't really ask any questions. This can work really nicely for those people who are using Airbnb. Not all holiday let lenders accept Airbnb. It's just worth pointing that out. So look, a really great offering from Foundation Home Loans with some pricing that has come down even further. They seem to price very frequently, which is why we seem to talk about them so often. Not a bad thing actually. It's great to see that they're constantly reviewing their proposition and making sure that it's remaining attractive and as competitive as it can be. Mixing up a bit this week, I'm going to talk to you about the Leeds, who have made rate reductions of up to 0.46% on their product range. Now, we don't talk about the Leeds so often, largely because they're not a lender who reprices frequently. And also I think it's fair to say their lending proposition, while it's very solid, there's nothing particularly exciting about it. Having said that, there are some USPs that are really worth sharing with you. So let's talk about their pricing first of all and what they've done there. So rates have come down. 2-year pricing now starts from 1.27% at 60%, 1.53% at 70% loan to value, and 1.78% at 75% loan to value. Their products do have flat arrangement fees, and there are incentives in terms of things like free valuation, free legal work, free mortgages. Now, in terms of the leads and the kind of thing that I think it's worth throwing out here, first of all, they're only lending to individuals, first and foremost. And secondly, they have a very kind of standard rental calculations. The calculation they're going to use, and this is irrespective of whether we're looking at 5-year fixed rates, 2-year fixed rates, or your tax band, is 145% coverage, assuming an interest rate of 5.5%. So realistically, if you're looking at properties which are either low yielding or highly geared, you're probably going to struggle. So this is going to be much better, much more suited probably to lower loan to value mortgages, or those people who are buying in those higher yielding areas. We'll come on to that later. But look, actually, if you can make those numbers work for you, there's some really nice pieces of lending policy here in terms of their criteria. 10 properties in the background, no maximum age on the application. They'll consider first-time landlords, they'll consider consumer buy-to-lets, and also they can consider flats over commercial and ex-local authority flats. Now, when we're looking at flats over commercial, with this, it's always a bit of a difficult one to really give clients real kind of certainty in terms of whether that would actually really be okay for a lender. So when we speak to lenders and they're discussing their appetite to lend on these kinds of properties, what they're going to largely say is that it can't be over things which are going to negatively impact resale. So flats over the properties, commercial, which are open late, so bars, restaurants, convenience stores. They don't like to be over things which can kind of be what they would call smelly, so over takeaways or restaurants. Also things where there are kind of hazards. So for example, an unusual one which people don't often pick up on is dry cleaners and hairdressers. That's because within these premises they tend to store chemicals which can be flammable. So when we're looking at things over commercial, there are kind of a fairly, I guess, defined list in terms of what lenders will and won't do, but it always comes back to being subject to valuers' comments. So you could find a property which is over an office building. The valuer goes out and says, yes, absolutely, the actual commercial that's under the premise is acceptable, but because it's in a very busy high street location, and I don't know, there's a pub directly over the road, we still wouldn't class this as acceptable security because we think the resale on this would be limited. So this doesn't just apply to the leads, this is for all lenders, but I really thought that was just worth going into in a bit more detail for you. Now, the other thing the leads have on their lending criteria, which I was just reading up on, is regarding the leaseholds. So leasehold flats are acceptable. They're able to accept flats with a floor space of at least 28 square metres, which actually is very, very small compared to most lenders. Most lenders are kicking at either 30 or 35 square metres. That's quite interesting. The other thing that they mention is the ground rents. They're saying that the ground rents either need to be tied to market value of the property or some kind of inflation measure. So what we're seeing is at the moment there are some lenders who are really looking at their policy regarding ground rents. Some leases have in them wording which means that the ground rents can essentially double every so many years. Lenders don't like this. The ground rent growth needs to be aligned to something fairly kind of inflation linked, that kind of stuff. So if you're looking at a flat, it might be just worth having a look at those terms and conditions before you start applying for mortgages, because this can be something where people come unstuck. Last thing just to note, they mentioned that the number of years left on a lease must be 45. That would be at the end of the mortgage term. So essentially the minimum term of a lease that they would accept on application is 51 years, which again is very, very good. So actually on the face of it, when we started this off, it wasn't sounding overly exciting, but once you get into the nitty gritty, leases have some very good pieces of lending policy kind of hidden in within their criteria. Okay, so in my selection process of who got a mention today, I was just tossing up between going through the pricing reductions we've seen from TSB and also BM Solutions. Here was my dilemma. TSB have reported pricing reductions of up to 55 basis points, which is incredible. BM Solutions has made reductions of up to 18 basis points, not quite so incredible, but actually the net position despite this is that BM Solutions are largely slightly more competitive on pricing. So I'm just going to cover them both off very briefly. Now, because they historically started off as part of the same group, when eventually TSB got split out, when the Lloyds Banking Group got kind of broken up, there's a lot of kind of similarities in terms of their lending criteria. There's also a couple of differences as well. So just to go into these in a bit more detail for you now. So TSB pricing is now starting from 1.34% at 60% loan to value, 1.69% at 75% loan to value. The policy with TSB is that you can have no more than 11 mortgaged properties. You need to earn £25,000 a year income. They're lending only to individuals, no limited companies, please. Now with TSB, a bit like the Leeds, the rental calculation will be an issue for some people. So on 2-year fixed rates, it's 145 at 5.5. On 5-year fixed, it's 145% at 4.5. But beyond that, really, I think it's fair to say the pricing is very, very good. Now, BM Solutions have, as I say, made reductions also. So their 2-year fixed rates are now, their pricing rather is starting from 1.38% at 60% loan to value, 1.62% at 75% loan to value. With BM Solutions, you can have no more than 10 mortgage properties in your portfolio, and no more than 5 of these can be with the Lloyds Banking Group. So this includes companies like Scottish Widows, the Halifax, Bank of Scotland, Cheltenham and Gloucester, among others. So just be mindful of that. Now, in terms of BM Solutions, say 10 mortgage properties in the background, no minimum income requirement is the other key thing here, and their rental calculation is more generous than TSB's. Now, beyond that, to compare the two, what I would say is that they're very, very good at slightly contentious properties. And this is going back to this thing about ex-local authority flats, flats over commercial. So these guys don't tend to have a really prescriptive policy. So we will not lend over on flats over takeaways, for example. They will always refer to the value of the comments. And the reason they take this stance, which I find really actually very pragmatic, although it can be confusing, I guess, in the same measure, is that they work on the basis that a flat over a takeaway on the King's Road in London would be regarded as much more easily to sell on than a flat over a takeaway on a high street in Huddersfield. Sorry, Huddersfield, nothing personal to you, but you'll understand the kind of comparison that I'm trying to make here. So what they do is always say it's down to valuers' comments. So actually what this does do is open the policy up. It can also mean that you don't really know where you stand until the valuer goes out. But obviously having some kind of choice and potential options is always going to be a good thing. So look, really good pricing from these two lenders, which has come in the last week. Just to run through very, very briefly the other changes we've seen this week. So we've seen pricing come down from the Ipswich, the Cumberland and the Furness. Now these guys are very good at expat lending and also holiday lets. So some pricing reductions in that space. We've also seen some pricing come down from Lambay and TML. These guys are very, very good at landlords with larger portfolios and limited companies, and also HMOs and multi-units as well. So in the round, an absolute flurry of pricing reduction. Like I say, I can't go into them all specifically because we'd be here all day and I'm sure you've got other things you want to be doing. But if you did want to have a conversation about any of the other ones which I haven't gone into in more detail, please just get in touch. We'd be delighted to run through those with you. Moving on to some data that's been released on rental yields covering off Q2 2021. So the average yield is now sitting at 5.8% for residential investment property. Now this is down slightly from 6% in Q1 2021. Are rents slipping? No, they're not. Are house prices increasing? Yes. So what really is going on here, I suspect, is that the slight drop in yield bears no reflection on actually what the rental income being received is. It's about the fact that house prices have gone up and rents haven't kept up with it or haven't caught up just yet. So I don't see anything there to worry about. So in terms of getting into the more granular detail here, so the landlords with one property average a yield of 5.4%. Landlords with 20 plus properties in their portfolio are averaging a yield of 6.7%. The average yield since 2015 has been 5.1%, and if you keep in mind that we're now sitting at 5.8, that really just shows an increment on terms of your return on capital. Looking at city yields now, so if you're thinking about investing in a city location, you may well want to consider Manchester, which has the highest yield, average yield, at 5.5%, closely followed by Sunderland 5.4, Nottingham 5.3, and Newcastle at 5.2. The weakest performing cities were Cambridge and Bournemouth. Now looking more regionally, so slightly more broadly, the top performing regions are Yorkshire and the Humber averaging 6.6%, the East Midlands averaging 6.2%, the North East and also the South West are both averaging 6.1%. Looking from the bottom up now, the weakest performing region would be London at 3.7%, the North West at 5.4%, and the East of England at 5.6%. I feel like I've just read out the football polls to you, by the way. But I hope that's helpful. I think when we're talking to our clients, a lot of people are looking to make some investments over the coming months. Yield is very much on people's minds, particularly when they're trying to balance their portfolio, drive up the income to kind of compensate for the higher tax people are now paying under Section 24. So actually, when we look at this yield information, I hope that helps you make some good investment decisions. That is me done for the week. I hope you found that really useful. What's going to happen next week? Who knows? Is there going to be another slurry of repricing? It's very, very hard to tell. The sense in the market is that lenders are really bottoming out on price reductions. So I'm not sure how much more we're going to see. Having said that, I did say that a few weeks ago and they've carried on going. So, who knows? But look, if you are in the market for a mortgage or at the moment, particularly for those people remortgaging, just keep in mind that the mortgage offers are valid for between 3 and 6 months. So even if you had a mortgage which is ending in kind of April next year, by the time we get the mortgage offer through, you'd need to allow for, really a month for that. And then you've got the mortgage offer valid for a further 6 months. So you can really apply for a mortgage now and lock in on the very good pricing that's available today, on the basis that, it probably won't be around and looking quite so competitive come the spring next year. Any questions, give us a call, 0345 345 6788, or have a look at the website. And that is it. So look after yourselves, have a great rest of your week, and I will catch you next time.